Brandon Whitmore, we need to discuss closing cost discrepancies on 74 mortgage
I've been in
loans.
mortgage origination for 20 years.
Brandon Whitmore kept his own records of every loan he manipulated. Clean originals on one side, forged addenda on the other. That binder is now Exhibit A, and it cost him 9 years of his life.
Closing costs vary based on lender requirements. Title company fees are standard industry practice. Everything is disclosed properly. $5.2 million in a...
74 home buyers. $5.2 million stolen from people taking the biggest financial leap of their lives. 41 of them spoke Spanish as their first language and had no idea what the line items on their closing disclosures even meant. By the time federal agents finished pulling files from a binder on the closet shelf in his locked office, Brandon Whitmore would be facing 49 federal counts. And the binder itself, the one labeled internal, would turn every signature he had ever collected into evidence against him. Quick question before we get into this one. Have you ever signed a closing disclosure without reading every line item on it? Be honest in the comments. Most people haven't. The man on your screen built an entire fraud on the fact that you and I, and almost every homebuyer in America, doesn't. If you're not subscribed yet, hit that button now. We cover the cases that hit people where they're most vulnerable, and this one hits in a place almost everyone has been or will be, sitting at a closing table, signing where the notary points. Brandon Tyler Whitmore was born in Mesa, Arizona, in the spring of 1978. His father was a residential roofer who had built a small two-truck operation servicing the East Valley. His mother kept the books for the business out of the family kitchen. From the time he was 8 years old, Brandon watched her sit at the table after dinner with a 10-key calculator, an accordion file folder full of receipts, and a yellow legal pad covered in column math. Money was always present in the Whitmore household. Money was always being counted. Money was always under negotiation between contractors, suppliers, customers, and the insurance adjusters who paid for storm damage repairs. Brandon understood early that the most powerful person in any room was the person who knew where the numbers were going. He graduated from Mountain View High School in 1996 with a B average and a part-time job at a sporting goods store at Fiesta Mall. He enrolled at Arizona State University that fall and declared a finance major in his sophomore year. His professors remembered him as quiet, organized, and unusually patient with spreadsheets. He completed his bachelor's degree in finance in May 2000 and took his first full-time job that summer at a regional lender called Desert Pacific Mortgage, working as a loan processor for $14 an hour out of a fluorescent-lit office park off the Interstate 10 freeway in West Phoenix. His performance reviews from his first 2 years at Desert Pacific described him as detail-oriented and comfortable with high-volume documentation work. His third-year review noted that he had demonstrated initiative in handling complex self-employed borrower files, the kind of files that required reading 2 years of business tax returns line by line, reconciling deposits against invoices, and writing letters of explanation that anticipated every underwriter question before it was asked. He was good at it. He was patient with the kind of paperwork most loan processors hated. In the fall of 2003, he moved to a national lender, a name on every freeway billboard in metropolitan Phoenix, and became a junior loan officer. He learned the architecture of a residential mortgage from the inside: the rate sheet, the lock desk, the appraisal management network, the title pipeline, the disclosure timelines mandated by the Real Estate Settlement Procedures Act. He learned which fees were negotiable, which were padded, and which the borrowers never even noticed. He learned that the people who originated the most loans were not always the people who knew the most about loans. They were the people who knew the most about borrowers. By 2007, he had been promoted to senior loan officer with a corner desk and his own assistant. The housing crash that followed nearly ended his career. Between 2008 and 2010, the lender shed 2/3 of its origination staff. Brandon survived 3 rounds of layoffs by quietly volunteering for the loan modification team, a department nobody wanted to be in, working with borrowers in crisis, fielding screaming phone calls from people one missed payment from foreclosure. He learned something in those 2 years that would later define his fraud. He learned how scared people sign anything you put in front of them. He learned that a borrower who has already given notice on a rental, already scheduled movers, already mailed change of address cards to relatives, will sign a document at the closing table that they have not read. He filed that knowledge away. He met his wife Megan at a charity golf tournament for childhood diabetes research in the summer of 2009. She was working in commercial title insurance, 4 years younger than he was, with a 6-year-old daughter from a previous relationship that Brandon would help raise. They started dating in October. They married in May 2011 at a venue in Sedona with red rock formations as the ceremony backdrop and 92 guests on the lawn. Their son was born the following spring at Scottsdale Osborne Medical Center, 8 pounds 2 ounces, and they brought him home to a 3-bedroom rental house in Tempe. By 2013, Brandon was originating again, this time for a different national lender, and his commission checks were back into the 6 figures. But he wanted out. He told Megan that working for a national wholesaler meant taking orders, splitting commissions, and dealing with corporate compliance officers who flagged half his files for paperwork that had nothing to do with whether a borrower could repay a loan. He wanted his own shop. He wanted to be the broker, not the broker's employee. He wanted to keep the full origination commission, set his own rates with the wholesalers, and stop sharing his pipeline with people who had not built it. In January 2015, he opened Silverline Mortgage Solutions LLC out of a 1,400 square foot office in a strip plaza off Scottsdale Road. He hired 2 loan officers, a processor, and an in-house compliance officer named Rebecca Halverson, who came with him from his previous lender. The lobby had a leather sofa, a Keurig machine, and a framed black and white photo of the Camelback Mountain skyline. The billboard along the 1001 freeway went up in October of the same year. Closings in 21 days, or your appraisal is free. His own face was on the billboard at half scale next to the slogan. It worked. Silverline closed 41 loans in its first year and 93 in its second. By 2017, Brandon was being quoted in local real estate publications as a small business success story. He joined the Scottsdale Chamber of Commerce. He sponsored a little league team in Mesa called the Silverline Sluggers and paid for their navy blue jerseys himself. Megan was pregnant with their second child. They moved into a 3,800 square foot stucco house in North Scottsdale with a pool, a 3-car garage, and a view of the McDowell Mountains from the back patio. To everyone who knew Brandon Whitmore in 2017, he was the kind of man Scottsdale wanted more of. A small business owner, a husband, a father of 3, a coach's sponsor, a billboard face on the freeway, a handshake at the chamber breakfast, a guy who paid his interns above minimum wage and who once wrote a personal check to cover the funeral costs for a borrower's father who had died mid-closing. And then in March 2018, he fired Rebecca Halverson. She had been with him from the beginning. The official reason given to the rest of the staff was restructuring. The actual reason, which would not surface for another 6 years, was that she had begun asking too many questions about a particular set of closing cost line items on a particular set of files. Items that she could not reconcile against any third-party invoice. Items he had told her not to worry about. After she was gone, he assigned himself the role of fee reconciliation officer. He told the remaining staff that he wanted to keep title relations under his personal control. Nobody questioned it. He was the founder. It was his firm. He had built it from the strip plaza up. That was the pivot. That was the moment the role he had created for himself. Sole signatory authority over every closing fee that left every Silverline file. Became the engine of everything that came next. To understand what Brandon Whitmore did, you have to understand the closing disclosure. The closing disclosure is a 5-page federal document mandated by the Consumer Financial Protection Bureau. Every borrower of every federally regulated residential mortgage receives at least 3 business days before they sign the final paperwork on their house. It lists every cost associated with the loan. Origination charges. Services the borrower shopped for. Services the borrower did not shop for. Recording fees. Escrow deposits. Prepaid interest. Title insurance premiums. The document is supposed to be the single source of truth at closing. It is the paper trail Congress designed in the aftermath of the 2008 crisis to keep people from getting fleeced at the table. In practice, almost nobody reads it line by line. The borrower is sitting in a title company conference room on a Friday afternoon. There is a notary at the head of the table. There is a stack of 47 documents in front of them, each one with a signature line at the bottom. They have already wired their down payment. They have already given notice on their old apartment or sold their previous home. The moving truck is scheduled for Saturday morning. The kids' school transfer paperwork has been filed. The numbers at the top of the page, the loan amount, the interest rate, the monthly principal and interest payment, those they have memorized. The numbers in the middle, the underwriting review fees, the document custody fees, the expedited processing fees, the third-party compliance audit charges, those they trust the broker on. Silverline used 4 primary title companies across Metro Phoenix. Brandon Whitmore had cultivated relationships with all of them since 2015. He was a high-volume referral source. At the firm's peak in 2021, Silverline was sending 212 closings a year their way. Each closing meant title fees, underwriter premiums, recording revenue, and escrow income for the title company that handled it. The title companies competed for his business. They sent his team holiday gift baskets. They invited him to their annual ASU football tailgate. When the broker on a 200-deal pipeline called the title office to flag a third-party service provider fee that needed to be wired out at closing, the title officer wired it. They did not call the borrower to verify. They did not call the lender to confirm. They wired it. The system was built on trust. The borrower trusted the broker because the broker had walked them through the entire process. The title company trusted the broker because the broker had sent them hundreds of files without incident. The lender trusted the closing disclosure because the closing disclosure was a federal document with the borrower's signature on it. Every link in the chain assumed the link before it had done its job. Nobody was paid to verify that a document custody fee had ever been incurred by anyone. Nobody asked who Cactus Ridge Servicing LLC was because the line item said it was a third-party service provider, and the document was signed by the borrower. That was the gap. That was the place where $4,000 to $41,000 could disappear from every closing without a single regulatory tripwire firing. Brandon Whitmore had spent 20 years inside that system. He knew exactly where the gap was. He had walked past it 10,000 times across his career. He had watched colleagues at his previous lenders pad fees by $200 or $300 and get away with it because the amounts were small enough nobody fought them. He understood the gap as well as anyone in Metro Phoenix understood it. And in January 2019, he stepped into it. The first inflated closing happened on January 11th, 2019. The borrower was a 34-year-old Mesa-based HVAC contractor purchasing his first home, a 1,900 square foot stucco ranch in Queen Creek for $342,000. He was self-employed. He had 2 years of tax returns and a bank statement loan product. He had been working with Brandon directly for 91 days, fighting through underwriting conditions and explaining every 5-figure deposit on his business account. He was tired. He was relieved. He wanted to close. His original loan estimate, dated October 2018, listed his total closing costs at $8,420. The closing disclosure he signed in January listed them at $12,520. The difference, a single line item called underwriting review fee, $4,100, went to a company called Cactus Ridge Servicing LLC, wired from First Sonoran Title at Brandon Whitmore's written instruction. Cactus Ridge Servicing LLC had been registered with the Arizona Corporation Commission 3 weeks earlier. The registered address was Brandon Whitmore's home in North Scottsdale. The business purpose listed on the formation documents was loan servicing consultation. It had no employees. It had no office. It had one bank account at a credit union in Chandler that only Brandon could access. The HVAC contractor did not notice. He saw the bottom line. He signed where the notary pointed. He got the keys to his first house and drove home to tell his wife. By March of 2019, Brandon had run the same pattern through 6 more closings. By June, he had done it 18 times. By the end of that year, he had inflated the closing costs on 41 Silverline loans, with overcharges ranging from $4,100 to $11,200 per file. The total taken in year 1 of the operation was just over $360,000. It went into the Cactus Ridge Credit Union account, then into a separate savings account, then into a custom kidney-shaped pool installation at the North Scottsdale house. The method was clinical. Brandon would prepare an accurate loan estimate for the borrower up front, required by federal law, given to the borrower within 3 business days of application. That document, the honest one, he kept. Then, in the final week before closing, he would prepare a revised closing disclosure with 1 or 2 additional line items inserted. The new items had bureaucratic, plausible names: underwriting review fee, document custody fee, expedited processing fee, third-party compliance audit. Each was made payable to Cactus Ridge Servicing, LLC, identified in the disclosure as a third-party service provider. He timed the delivery of the revised disclosure to maximize pressure. CFPB rules required a 3-day waiting period after disclosure delivery for material changes. Brandon would deliver the revised version at exactly the 72-hour mark, often by email at 6 p.m. on a Tuesday, with a brief note. Final numbers attached. Looking forward to Friday's closing. Let me know if you have any questions. If a borrower called him after reading the new numbers, and most did not, because most assumed the original loan estimate had been an early ballpark, he had a script. The fee was a standard charge from the underwriter. It was the cost of expedited processing. It had been disclosed in the line item count on the loan estimate, but consolidated into a single number, and this was the breakout. The borrower, who had already wired their earnest money, who had movers scheduled, who did not want to lose the house, would let it go. If they did not let it go, Brandon went further. He would tell the borrower he had received an updated disclosure addendum that corrected an error. He would arrive at the closing with a single addendum sheet, the one with the inflated numbers, the one that matched what the title company would actually wire, and tell them it superseded the prior version. If the borrower hesitated, he would say the original sheet had been wrong and that the corrected one was just for the file. Some borrowers signed it without reading. Others did read it, asked questions, and were told the same thing. Some signed under pressure with a moving truck parked in the driveway of their new home. 41 of the 74 eventual victims spoke Spanish as their first language. Some had brought adult children to translate at closing. The children, too, were unfamiliar with how a mortgage disclosure was supposed to read. Brandon would speak softly. He would explain in confident, friendly English. He would point to where they needed to sign. The signatures came. The keys changed hands. The wires went out. By 2021, the operation had escalated. Brandon was no longer adding 1 or 2 inflated line items per file. On larger loans, he was adding 3 or 4, and his overcharges were ranging from $14,000 to $32,000 per closing. On a single $787,000 jumbo purchase in Gilbert that summer, the inflated fees totaled $41,500. He had stopped being careful. He had started being greedy. The pressure on the title companies escalated too. When one closer at First Sonoran Title flagged a $19,000 document custody fee on a 2221 file and asked Brandon for backup documentation, he called her branch manager directly the same afternoon. He told the manager that Silverline was reviewing its title relationships and would be moving all of its volume to a competitor across the city if its closing instructions were not followed without question. The manager, looking at a quarterly report that listed Silverline as one of her branch's top 5 referral sources, told the closer to wire the fee. She did. The closer did not last another year at the company. The money flowed into Cactus Ridge, and from Cactus Ridge into a savings account, and from the savings account into the pool installation, a second vehicle for Megan, a vacation home down payment in Sedona, and a 2022 Range Rover. The lifestyle changes were never extreme enough to trigger anyone's attention. Brandon was a successful mortgage broker. Successful mortgage brokers had pools. Successful mortgage brokers drove Range Rovers. Successful mortgage brokers bought second homes in Red Rock Country. By August 2023, the operation had run for 4 years and 7 months. 74 borrowers, $5.2 million. Brandon Whitmore had stopped keeping mental count of the individual files, but he kept the binder. In May 2023, a 38-year-old accountant named A.M., a Phoenix-based controller for a regional logistics company, closed on a $448,000 townhome in north central Phoenix. She had used Silverline because her real estate agent recommended Brandon Whitmore as the guy in Scottsdale for first-time professional buyers. The closing went smoothly. She signed everything she was asked to sign. She got the keys. She moved in over Memorial Day weekend with help from her sister and a hired moving crew. 3 months later, sitting at her new kitchen counter on a Sunday afternoon in August with a glass of wine and a manila folder, A.M. did something most homebuyers never do. She read her closing disclosure line by line. She was an accountant. Reading line items was what she did for a living. And on page 2 of her closing disclosure, in section B, services borrower did not shop for, she saw a charge she did not recognize. Document custody fee, Cactus Ridge, Servicing LLC, $14,200. She did not remember anyone called Cactus Ridge being involved in her closing. She pulled up her original loan estimate from October. The document Brandon had emailed her at the start of the process. The document she had filed in her digital records, the way she filed everything. The loan estimate had no line item for Cactus Ridge. The total closing costs on the loan estimate were $9,800. The total on the disclosure she had signed at closing was $24,000. She Googled Cactus Ridge Servicing LLC. She found the Arizona Corporation Commission filing in under 30 seconds. She found the registered address. She cross-referenced it against Brandon Whitmore's address, which she had on a business card he had given her at their first meeting, and which she had stapled to the inside cover of her file. They matched. A.M. spent the next 4 days assembling a packet. She pulled her loan estimate, her closing disclosure, her wire instructions from the title company, the business card, the corporation commission filing, the bank statement showing the earnest money she had wired, and her email thread with Brandon. She drove to the Phoenix office of the Arizona Department of Insurance and Financial Institutions on a Tuesday morning in late August and filed a formal complaint in person with a supervising examiner. That night, she did one more thing. She had been a member of an online forum for Phoenix area homebuyers since 2021. She wrote a long, detailed post. She did not name Brandon. She did not name Silverline. She described the charge, the entity, the address mismatch, and the discrepancy between her loan estimate and her closing disclosure. She asked, in the final paragraph, if anyone else had seen anything similar at their own closings. Within 48 hours, the post had 11 responses. 3 were from Silverline borrowers describing identical charges to Cactus Ridge Servicing LLC at their own closings. 2 more came from borrowers who had refinanced through Silverline. 1 was from a borrower who had walked away from a Silverline closing in 2022 after a similar dispute and had never told anyone. He had simply found a new lender and never mentioned the experience to anyone in his life. By the end of the week, the forum thread had 38 responses. AM forwarded the entire thread to her contact at DFI. DFI forwarded it to the FBI Phoenix field office on the 8th floor of the federal building on North Central Avenue. The investigation that would end Brandon Whitmore's career began the following Monday morning in a conference room on that 8th floor with 2 agents, a financial crimes analyst, and a printout of a homebuyer forum thread spread across the table. Brandon Whitmore was at his office in Scottsdale that Monday on a phone call with a title officer trying to close another loan. The first thing federal investigators did was nothing visible. For 4 months, from early September through late December 2023, the FBI Phoenix field office and Arizona DFI ran a parallel investigation with no contact to Whitmore, no visible subpoenas, and no public filings. They served sealed subpoenas on the 4 title companies Silverline used. They subpoenaed Silverline's complete loan file inventory for every closing the firm had handled from January 2019 forward. They pulled Cactus Ridge Servicing LLC's complete bank records from the credit union in Chandler. Every wire in, every wire out, every check cashed, every transfer to Brandon's personal account. The match was clean and devastating. Every wire from a title company to Cactus Ridge corresponded to a specific line item on a specific closing disclosure, on a specific Silverline file, for a specific borrower. The agents began calling the borrowers themselves, one at a time, on weeknights when people were likely to be home. The first round of borrower interviews returned a pattern. Borrowers had no idea who Cactus Ridge was. Most had not noticed the line item at the time. The ones who had asked at closing remembered being told it was an underwriter charge or an expedited processing fee. Several described being given a final hour addendum they were told was just for the file. Multiple borrowers remembered Brandon Whitmore personally walking them through the document and pointing to where they needed to sign. 3 borrowers remembered him telling them not to worry about it, that everything had already been verified by the lender. And then the investigators ran the signatures. This was the moment the case stopped being a fraud case and became an aggravated identity theft case. A forensic document examiner from the FBI laboratory in Quantico, Virginia, compared the borrower signatures on the original loan estimates against the signatures on the disclosure addenda actually filed with the title companies. In 12 cases, the signatures did not match. The pen pressure was wrong. The slant was wrong. The letter forms had been replicated by hand, by someone who had clearly studied the original. But the natural variation in human signature production cannot be perfectly faked. 12 borrowers had never signed the addenda that authorized the inflated fees. Someone else had signed for them. That conclusion meant Title 18, United States Code, Section 1028A, aggravated identity theft. A separate, mandatory, consecutive 2-year federal sentence on top of any other count, with no opportunity for the sentencing judge to run it concurrently with anything else. In late January 2024, federal agents executed a search warrant on Silverline's office in Scottsdale. They arrived at 8:14 in the morning on a Tuesday. Brandon Whitmore was not in the office yet. His operations manager, a 31-year-old woman named Vanessa, who had been with the firm for 6 years and who had attended Brandon's wedding, let the agents in and called Brandon's cell phone. He arrived at 8:41. He stood in the lobby of his own brokerage and watched federal agents carry boxes out of his office. They found the binder in a locked closet inside his private office. It was on a shelf at eye level, between a stack of Maricopa County zoning maps and an old broker exam study guide from 2003. The spine was labeled internal in black marker, in Brandon's own handwriting. Inside were the original loan estimates given to each of the 74 borrowers, clean, accurate, signed in their own hands at their kitchen tables and their dining rooms and Silverline's lobby. Stapled behind each one was the addendum that had actually been wired and filed at closing. Same loan number, same buyer name, same signature, in some cases forged. $4,000 to $41,500 higher. He had kept the receipts of his own fraud. The agents would later say in their report that no document examiner work was even necessary on most of the 74 files. The binder did the comparison for them. Brandon Whitmore had assembled it himself, page by page, over 4.5 years. We're heading into the confrontation now. If you've made it this far, you already know this case is different. The man on your screen didn't just steal. He documented every single theft and kept the documentation on his own office shelf, in his own handwriting, behind a lock he held the only key to. Subscribe if you want to see how the federal system handles a fraud this clean. The sentence in this one is going to surprise you. Federal agents asked Brandon Whitmore to step into a back office for a conversation while the search warrant was executed. He agreed. He sat down across the desk from a special agent from the FBI Phoenix field office and an investigator from Diffie. A body cam recorded the conversation from the agent's chest. The agent set a single sheet of paper on the desk between them. It was a copy of one of the original loan estimates from the binder. Mr. Whitmore, do you recognize this document? That looks like a loan estimate. Whose file? I'd need to look at the loan number. The agent set a second sheet on top of the first. the disclosure addendum from the same file. Brandon glanced at it. His hand went to the back of his neck and stayed there. His shoulders, which had been squared toward the desk, rolled inward by a 1/4 inch. Same loan number, same borrower, different totals, difference of $17,400. Charge made payable to Cactus Ridge Servicing, LLC. Who's Cactus Ridge, Brandon? He did not answer right away. His operations manager, Vanessa, was visible through the open door, sitting at the front desk, watching the agents carry the binder past her in a clear evidence bag with a yellow chain of custody tag attached. Cactus Ridge is a third-party service provider that handled compliance review on some of our files. It's registered to your home address. Yes, I can explain that. The registration was a procedural thing. We were going to relocate it. It has no employees, no office, one bank account at a credit union in Chandler, and every dollar that's ever moved through it came from a Silverline closing wire. Brandon, we have the binder. He stopped looking at the agent. He looked at the desk. I'd like to call my attorney. That's your right. He never spoke another sentence to a federal investigator without counsel present. He stood up. He looked at Vanessa through the open door. He walked past her without making eye contact. The agents allowed him to leave the building. He sat in his black 2022 Range Rover in the Strip Plaza parking lot for 19 minutes before turning the key in the ignition and driving home to North Scottsdale. Those were the last words he spoke as a free broker. The federal indictment came down on February 14, 2024, a 49-count document filed in the United States District Court for the District of Arizona. 28 counts of wire fraud under 18 U.S.C., paragraph 1343. 9 counts of bank fraud under 18 U.S.C., paragraph 1344. 12 counts of aggravated identity theft under 18 U.S.C., paragraph 28A. State charges from the Arizona Attorney General, fraudulent schemes and artifices under ARS, paragraph 13, 2310, and forgery under paragraph 13, 2002, were filed in parallel and would later be dismissed as part of the federal disposition. Brandon Whitmore retained a former assistant United States attorney named Daniel Cordova as defense counsel. Cordova negotiated for 6 months. There was no version of this case to take to trial. The binder existed. The wires existed. The forged signatures had been verified at Quantico. The borrowers had been interviewed and re-interviewed. The plea agreement Cordova produced on September 30th, 2024, traded a guilty plea on the wire fraud, bank fraud, and aggravated identity theft counts in exchange for dismissal of the state charges and a sentencing recommendation cap of 132 months. The sentencing hearing was held on February 11th, 2025, in Courtroom 502 of the Sandra Day O'Connor United States Courthouse in downtown Phoenix. United States District Judge Lillian Varick presided. The gallery was full. 11 victims testified or submitted written statements. The Mesa HVAC contractor, the first victim, the first inflated closing, back in January 2019, sat in the second row of the gallery with his wife. He did not speak in court. His statement was read aloud by an assistant United States attorney. It described what it had felt like, after 4 years of believing he had finally bought his family a home, to learn that the man who handed him the keys had stolen $4,100 from him at the table. A young woman who had purchased a townhome with her mother, both immigrants from Hermosillo, Sonora, both Spanish-speaking, testified in person through a court-appointed interpreter. She told the judge that her mother had cried for 2 days after learning the truth. Not because of the money, she said, because her mother had thanked Brandon Whitmore by name during the closing in Spanish and brought him a gift of homemade pan dulce wrapped in a checkered cloth napkin the following week, and had kept his business card in her wallet for 2 years because she said he had been kind to them when nobody else at the bank had been. A.M., the accountant, gave the final statement. She did not speak about herself. She spoke about the 73 other borrowers and what it had meant that one person reading her own paperwork had been the difference between this man continuing to operate for another 2 or 3 or 5 years, and this man being stopped. I am not a hero, she told the court. I am an accountant. I read the numbers. The numbers told the truth. The system was supposed to read them for me, and it did not. Somebody else should have caught this years ago. Judge Varick addressed Brandon Whitmore directly before pronouncing sentence. Her statement was entered into the record verbatim. Mr. Whitmore, you were not desperate. You were not in crisis. You were not making a choice between feeding your family and committing a crime. You were a licensed professional running a successful brokerage who chose, over the course of 4.5 years and 74 separate transactions, to steal from the people who trusted you the most. You targeted first-time buyers because they did not know the system. You targeted Spanish-speaking buyers because the language gap made your fraud easier and your victims slower to push back. You kept a binder of your own misconduct in a locked closet, which tells this court that you understood, every single time, exactly what you were doing. You read the original loan estimate, you wrote the inflated addendum, you stapled them together yourself. This sentence reflects that understanding. She sentenced him to 108 months in federal prison on the wire and bank fraud counts. 3 years of supervised release. Restitution of $5,247,800, payable to the victims through the United States Probation Office. The 2-year mandatory consecutive term on the aggravated identity theft count was imposed on top of the 108 months, a total of 132 months, the cap allowed under the plea agreement. Arizona DeFi permanently revoked his mortgage broker license, effective the day of sentencing. The nationwide multi-state licensing system permanently barred his registration. He was designated to the Federal Correctional Institution at Safford, Arizona, a low-security federal facility approximately 3 hours southeast of Phoenix in the Gila River Valley. His projected release date is in 2035, when he will be 56 years old. His son, who was 12 at sentencing, will be a sophomore in college. His daughter, who was 19 and in her second year at the University of Arizona, will be 30. Megan Whitmore filed for divorce 4 months after sentencing. The North Scottsdale house was sold to cover restitution and legal fees. The Sedona vacation home was sold. The 2022 Range Rover was sold. The Silverline billboard along the 101 freeway came down in March 2025. A Tempe area orthodontist's advertisement went up in its place by April. The binder is in federal evidence storage. The original loan estimates inside it have been returned to the 74 victims who signed them. Clean documents with the honest closing costs printed on them, the way they were always supposed to read. AM has hers framed in the home office of the townhome she bought in 2023. She told a local reporter in March 2025 that she keeps it on the wall as a reminder to read her own paperwork. All of it. Every line. Every time. This case was hard to sit with, but the case on your screen right now is the kind of betrayal that takes the wind out of you. Click it.